FTSE 100 stalwart and high street bellwether Marks & Spencer has today issued its first half numbers, cut its margin guidance and outlined details of a restructuring plan under new boss Steve Rowe, who took the helm from Mark Bolland just over 6 months ago. The shares are broadly unchanged in early trading to suggest investors are not quite sure what to make of Rowe's restructuring. So let's quickly dive into the numbers, the outlook statement, and then see what the new boss is trying to achieve. So, on a stated basis, looking at the numbers, pre-tax profit fell 88% to just 25 million quid, although that figure was dented by £206 million of exceptional costs relating to the pension scheme and that restructuring, to which we'll return in a second. Adjusting for all that, pre-tax earnings still fell 19%. The trends in like-for-like sales showed improvement at Clothing and Home, a mere 2.9% year-on-year drop in the second quarter to compare to an 8.9% plunge in the first 3 months, but the trend is still down. Food slipped 0.9% like-for-like and M&S.com's 0.4% growth, well, that looks pretty feeble in an online context. The final feature of the numbers is an unchanged interim dividend at 6.8 pence a share. M&S has declined to repeat last year's share buyback or the first half special dividend, owing to the uncertain trading environment and the costs of the restructuring. So those are the numbers. In terms of the outlook, there are 3 key points. First, M&S has cut its gross margin guidance to an increase of 0 to 0.5% from an increase of 0.5 to 1%. The plunge in the pound and its effect on buying costs is a big issue here. Second, M&S has cut its capex budget by 10%. And third, the P&L will be burdened by restructuring costs of around £150 to £200 million this year on top of that big pension charge. So the cut in margin guidance may be weighing on the shares, even as investors digest Rowe's long-term, long-awaited turnaround plan, which has got 2 key thrusts. On the international front, the business there will be run on a franchise basis which lowers cost and lowers risk in a bid to eliminate £45 million of annual losses. Domestically, a quarter of Clothing and Home space will be repositioned, presumably towards food, albeit at a 3-year cost of 150 million sterling. So the question you have to ask yourself now is, does this make sense? Is M&S capable of getting clothing right to the degree it does food? And what is already factored into the very soggy share price? Remember, the shares trade where they did back in 1992 under Sir Richard Greenbury, and they offer a yield near 5.5% on a forward PE of barely 11 times. However, the dividend cover is thin at well less than the 2 times comfort zone, and for a value to out, the stock needs a catalyst, ideally a fresh increase in profits, as the firm's set to earn less in 2017-18 than it did 10 years previously, if consensus forecasts are right. Now, whether any improvement in profit comes from internal change or a better economy, or simply fails to appear at all, will dictate what the shares do from here. So thank you for watching, and I look forward to seeing you next time.